Hello everyone, this is Juan Sarmiento and today is Friday, June the 16th. Let's take a look at some candidates today I have, including Adobe, Oracle, and WDay. Okay, I have my spreadsheet here with Adobe, WDay, and Oracle. And we will examine them and then take a look first at our existing trades. Okay, Oracle we already have, but we're going to change that. Okay, let's start with ISRG, and since we started back here when they reported earnings, I think it's been going up nicely. And let's take a look at the Analyze tab, and here's my cost, and this is what it would be now, but you can see that is $1,595. Okay, you can see that my smiley face would have been here at 314 and it's now 330, so we need to roll it up, meaning the outstanding calls need to be moved up. What do I mean by outstanding calls? Well, you can see that we have 4 longs and 4 shorts in the call. So the 4 longs minus the shorts, you have 2. So those 2 are my outstanding calls. And what I mean by rolling it up, I mean by selling what we have, those 2 that we have outstanding calls, and buy something at a higher strike price as a way to take profits while keeping the deltas pretty positive. Right now the deltas are 94. So if I say analyze rolling, reduce it to 2 only, I will be buying the July. It needs to be the same strike price, and what would it would be, sorry, it would need to be the same expiration and a different strike price, the higher strike price. What would it be? Well, if the stock is right now at 330, you can say 330. If you want to neutralize your deltas even more, you can go a little higher. But let's go 330 first. And the expiration should be the same day, July the 21st. And that will give us $2,610, which is the price that the credit we have times 100. And yeah, that remains delta positive. Do I want to remain delta positive? Well, you know, the stock is hitting new highs. So perhaps it's due for a correction. Well, if you are afraid of that, just simply increase the strike price to 35. And that will give you even a further credit, and your deltas reduced to 21. I think that's okay, because if the stock drops for whatever reason, it will be with increasing volatility. And so let's do this right away, and that will give us a credit of $5,720. Okay, and that will reduce our money committed to this trade. Okay, now June 23rd is the expiration of my shorts, and so that's due next week. So with 7 days to expiration, we can roll over the calls. So let's say analyze rolling. And how far would I go when doing the rolling? Rolling means I'm going to buy back the 2 June 23 295 calls and sell the same strike price a month later. Well, you can see that a month later will be our expiration. So we're going to do 1 week before that. So that will be July the 14th. It's about a month from now. So that sounds great. So we'll buy what we have and sell 1 month from now. In this case 14, and that will give us almost $2 or $200 more credit. And look at that. With that, our deltas, let's see the rollover here. By having the rollover and the roll up together, my deltas end up at 37, which is very nice, okay, very acceptable. Okay, as far as the puts, well, what if the stock went down and next week we find the puts at 295? Well, that would be a time to roll them over. If it stays where it is, well, we can sell the July 14 puts at 295 next week. So we'll do that later. I can afford to do that because it's so high up here, it makes sense. Okay? It's way, the puts are way out of the money. So we are in no hurry. Okay, I'll be back to this in a minute to make sure that this gets done. Okay, let's take a look at PA and W. Again, this is my smiley face here, so the stock has gone up way over to 245 while my strike price is 210. Again, we do the same thing. We roll up the outstanding calls, which is 2 September 210 calls. So, and we got the vertical. That's the roll up rather, on the ISRG. Great, we took profits there. Let's do the analyze rolling here for the PA and W. And what I want to do, keep the same strike price, only, keep the same expiration date, only increase the strike price to 45 if there is such a thing. Yeah, there should be. September, no, there isn't. Okay, so you have two possibilities. You can stay at 240 or 250. Let's do 250. And it depends. Well, then if I did that, look at the deltas become negative, so I don't want that. But what if we did a rollover? Am I gonna? No, the rollover is the week after. So I think what I wanna do is go back to the 240. And that keeps my delta still to negative, okay? Oh, it's because I'm doing 4. You see, that's my mistake here. I need to do 2 only. Okay, that's better. So let's do the 250 again. I see what our deltas are. Perfect, that's a delta neutral, okay? I want to do that because the stock is through the roof right now. So a correction is expected. I would expect a correction. Of course, I'm often wrong, so don't take me too seriously. Okay, but just in case, I do my rollover, take some profit, neutralize my deltas. All right, let's go to Oracle. Oracle reported earnings and it's doing really well. And look at what I have. I have calls that I rolled up to 210, but my puts, they're pretty worthless, except for this thing here. Okay, so we can close these puts. Starting with this simple one. And the calls can be closed, and I'm planning to enter a new trade. If you take a look at Oracle, the volatility is low, the chart is green, and I just need to take my profits because the stock has moved up so much. I want to sell this to 10 calls. Go to the top, to the mid, and then correct down. There. We can close 9 of the puts. 9 because the other goes with the short. So this is the long, and I'm just getting a few cents out of that. You can keep it as a lottery ticket if you don't mind losing a few cents. $117. Yeah, I want to close that. There. And now you end up with a calendar here, and I'm letting it see if it will fill at 7 cents. Okay, review our data here. The credit of the calls, it could go down a little bit. So I unlock it to get to 125. 130. And if it doesn't cooperate, we just keep changing it. Okay. Cancelled. Okay, so it's working at 130. The ISRG, okay, is 170. 130 should fill, but it's very wide because it's so out of the money. It's a wide, very wide bid and ask. Okay, we can reduce also the asking for the PA and W, cancel, replace, and just unlock it and adjust as we go. Okay, we will come back to that. Okay, let's start with that position at Oracle. Okay, ISRG. All right, let's start with Adobe. All right, so I have my spreadsheet here. Let's start with Adobe, and this is the trade I proposed. We need to look at, let's copy that and take it here. So I create these things in my actual account and then bring them here to evaluate. So let's analyze that. And I'm having only one here, one trade, meaning one Genie, and it costs $995.80 times 100 is $9,000, which is, I can go to $10,000 and that will be 10% of my account, which is right now 100,000. Okay, so what do I do with this? Unlock it, and let's go to the chart, and then we'll come back to the price here and see if it is a good idea or not. You see how the stock has jumped, and if the stock is going up after earnings, you can still enter a Genie trade. Even if it goes down from here for whatever the market collapses, you will do fine. If it goes sideways, well, that's you will do okay. And if it continues this rally, well, you would make money on delta. So let's go to our chart here, and the price is 95, so times 100 times 10, it will be times 95 times 100, it will be $9,580. And here you can see my strike price and my expirations. You can enter this to memorize that in your spreadsheet. Okay, now I go to the earnings here. You can see they were expecting $3, they got $3.91 in the earnings. So I have them both here, and so the difference is 30%. So they were expecting 3, they got 391. That's about 30% over the expected. Let's go to the volatility skew and go to the analyze tab. That's my trade here, and I use these numbers here at the bottom right corner of your screen. That's the volatility on each one of the options, and we start with the back month and then the short month, the front month, and calls and puts consecutively. So we come over here, calls, back month. So I have organized them exactly as you see them here. So 35.43 and 28.88. 32.61, 29.95. Okay. Let's review. Yeah. Okay, so as you can see, this is less than 3%, you can trade it. Next, the liquidity. You have the mid and the natural. So you create the trade, create duplicate order, and here's your mid and your natural. Okay, so we are going to use those two numbers here at the bottom right corner of your screen. Okay, that's where my arrow is. I come over here in the liquidity and enter 94.8, 96.55. and the difference is 1.8%. That's quite all right. We can trade it. And the last thing is the current IV percentile. For that, let's go to the trade tab and scroll down to where it says today's option statistics, and you can say the current IV percentile is 18%. Normally is 15% what I would accept, so 18 is marginally above, so it says do not trade. But I have the other three items. This is not that important and is really low compared to, okay, so the chart is yellow, but it should really be green. I will make a pause here. Okay, so yeah, that looks fine. The chart is a little weird in that it's yellow still. It should be green, particularly after earnings. But I think all in all, the percent is 33%. It might go a little lower, but eventually I don't want to miss the opportunity if this stock continues to rock up. So I'm going to do it, unlock it again, and I like this price. Create duplicate order, confirm and send, and you can see that it's less than $10,000, which means it's less than 10% of my account, and so I'm going to send that off. Okay, we'll come back to it to make sure that it gets executed. And now let's go to WDAY. All right, and here we have September, June. I would like to go to July 14, which will be really 1 month, more or less. Yeah, 1 month from now. September is about 90 some days. The middle September is 91 days. Okay, so I told you before I want it to be 90 or more, so 91 will be fine. And you can see here the prices. Let's go to the chart, and to our table here I have WDA, and you will fill out the same way, these things the same way. And so in this case 45.19, I can do two of them. Okay, so 45.19 times 100 times 2 gives me 9,000, which is less than 10% of my account. Let's go to the earnings, which occurred a little while back, but I want to justify it. You can see the estimate was negative and they beat expectation by, well, obviously I don't even need to calculate it. It was negative before and now it's positive. The percent is, significant no matter what you say. Okay, so that's a do. The green chart here looks good too. Let's go to the volatility skew and such. Let me make sure that I have the same trade. Strike price 210. No, 220 should be. Looks like the Adobe just got filled. Okay, so I'm going to actually copy it from here and take that over here. And you can multiply that, 43.73. Yeah, okay, so let's go. The expected, it was like 0 or negative. Let's say 0.01 versus 1.5 or something. Let's see what it was, 1.31. So yeah, that's a no-brainer. Okay, and okay, way better than expected. Okay, so let's look at the volatility skew here. That looks a little difficult. 35.86, 29.89 versus 31, 27.5. This is going to be 5%. That's a no go. I don't even bother with anything else because the skew, it means we are paying too much for the trade essentially. Okay. This might change. You can keep an eye on it, and if you're really interested, you might change that. Okay, let's go to Oracle, and first let me check what the trading has been. Okay, I can see that the ISRG, both trades were filled. Oracle pretty much also. I'm waiting for those put in Oracle. We can leave that. If it gets filled, we can say cancel, replace, and say good until cancel. So we don't have to bother. It's after all 7 cents only. You don't have to fill it up, but it's better to fill it. But we'll see. And the PAW, yeah, that's a little too much credit. So cancel that. Cancel, replace. Unlock it. And we're getting closer and closer to get filled. It's just, you play with it, you don't take whatever order. You know, there it is, got filled immediately, good. But if you create a trade, it may be wide and you don't go to the natural right away. You go approximating from the mid, little by little, and only in the worst case scenario, you do the natural. Usually it will fill somewhere there. Or if you're lucky, it will fill here, depending on the demand for these options, okay? All right, so let's go now to the Oracle trade. Analyze that. I have it here. Let's copy it from here. Let's make sure that this is what I want. And paste it here. Let's analyze it. Hide the existing trade. Hide position. Take a look at it. What is the cost? The cost will be 21.57 times 4. Create duplicate order, confirm and send. 8,600. We could possibly add one more. We'll see in a minute, okay? Look at the volatility, 31, 25, 26, 24. Okay. Let's go fill it up over here, starting with the expected versus the actual earnings. And you can see here that the expected was 1.31 and the actual was 1.67. 1.31 versus 1.67, and that's 27% over the expected. Fantastic. This is exactly what we want. Now we can go to the volatility skew. Go to the Analyze tab. And here we have first the back month, 31.8, 25.7. You see that I'm filling it up from the bottom here, bottom right corner of your screen. That's where the volatility of each leg is. 26.38, 24.68. Okay, the difference is 3.2. Okay, it says do not trade. Okay, this is very, very borderline. Okay, I would say if you're really motivated, go ahead and fill it. Let's see what liquidity. I have no question that Oracle will be very liquid, but create duplicate order and you enter those numbers, mid and natural here. Mid is 21.53 and natural is 22.05, so that's less than 3%. And then the current IV percentile, you can look at it in the chart, and it's very close to the bottom here, or go to the trade tab, scroll down to where it says option statistics, and it says 32. That's a little higher than I would want it, but still is towards the lower end. If you decide to wait for this, I would understand that. In my case, the earnings were fantastic, and the liquidity is a liquid stock, and the volatility skews marginally less than I would want. So yeah, I still make the trade in this case. It should, it's a balancing act. You want it, so how badly you want it. I think I want it pretty badly because the stock is going through the roof and is likely to continue on like that for a while. So I want to be in this trade, okay? So let's go to the Analyze tab, create duplicate order, confirm and send, and let's say multiple accounts so we can control here. Let's put 0 here and go up until it's 9. No, 5 is too many, 4 is okay. And you may look carefully at the expirations. Yeah, 14 is a month from now, and the long-term options is 91 months from now, so 91 days from now, sorry. Okay, so 21.49 sounds good. Let's send that off. My cost is going to be $8,500. And then I keep looking at this. Carefully until it gets filled. Okay, so you can see here my debit, what I am bidding on it, is quite below the ask. So I say cancel replace and put it somewhere in there, closer to the mid, meaning we're paying less. Somewhere there, and I'm going to leave it here, but I will come back to it. You can see that my bid is a little higher than the mark, okay, by 20 cents. So that's quite all right. All right, don't be, play with it until you get the price you want, I would say. Okay, that's all for today. Thank you very much for joining me, and see you next time. Bye-bye.